Listen, out to show you something that 95% of crypto investors get completely wrong. While everyone's chasing the next 100x moonshot, there's a small group of smart money players who've been quietly building wealth using a completely different approach. They're not gambling, they're strategically positioning themselves for long-term success with what I call the boring millionaire method. And today, I'm going to break down exactly how to build a $1,000 conservative crypto portfolio that could potentially outperform most aggressive strategies over the next 12 months. But here's the thing, this isn't financial advice, and I need you to stick around until the end, because the asset allocation I'm about to reveal in part 4 will probably surprise you. Before we dive in, smash that like button if you're tired of losing money on risky crypto plays, and let me know in the comments what's your biggest fear when it comes to crypto investing. I read every single comment. Disclaimer, quick disclaimer before we get started. This is purely educational content. I'm not a financial advisor, and this is not financial advice. Never invest more than you can afford to lose. Cryptocurrency is highly volatile and risky. Always do your own research and consider consulting with a qualified financial advisor before making any investment decisions. Here's exactly what we're covering today. First, I'll reveal why conservative crypto portfolios consistently outperform aggressive ones. Then, we'll break down the 5-asset allocation strategy that minimizes risk while maximizing stability. I'll show you the exact percentages and dollar amounts for each position. We'll cover the staking strategies that can generate passive income. Finally, I'll share the rebalancing system that keeps your portfolio optimized. Authority building. Now, you might be wondering, why should you listen to me about conservative investing when every crypto YouTuber is talking about the next 100x gem? Here's the truth. I've been in this space for over 6 years, and I've seen 3 major bull runs and 2 devastating bear markets. The investors who survived and thrived weren't the ones chasing hype, they were the ones who understood risk management. Drop A in the comments if you're ready to learn about real wealth building instead of get-rich-quick schemes. The biggest mistake I see new crypto investors make is thinking they need to risk everything to make meaningful returns. They'll throw their entire $1,000 into some random altcoin they heard about on Twitter, then wonder why they're down 80% 6 months later. But what if I told you there's a way to potentially grow your $1,000 while actually sleeping well at night? That's what we're building today. Portfolio designed for capital preservation. First, steady growth. Second, and maximum peace of mind. Always. And hey, if you're finding value in this content, make sure to subscribe and hit that notification bell. I drop new crypto education videos every Tuesday and Friday. The conservative portfolio philosophy. Let's start with the mindset shift that separates successful crypto investors from the gamblers. When you hear conservative crypto portfolio, you might think that's an oxymoron, but here's what the smart money knows. A conservative crypto portfolio has 4 non-negotiable principles. First, risk minimization. We're not trying to hit home runs. We're playing for consistent singles and doubles. The goal is to never lose more than 20% of your capital in any major market downturn. Second, time horizon. We're thinking 6 months minimum, ideally 12 minus 24 months. This isn't day trading or swing trading, this is patient capital deployment. Third, diversification across different crypto sectors. We're not putting all our eggs in one basket, even if that basket is Bitcoin. Fourth, passive income generation where possible. Why let your money sit idle when it can be working for you? Comment conservative if you're ready to stop gambling and start investing. Here's something most people don't understand about crypto markets. The most explosive growth often comes after the most boring accumulation phases. While everyone's looking for the next Solana or Dogecoin, the real money is being made by people who consistently buy quality assets during quiet periods. The institutional money, the BlackRocks, the Fidelities, the pension funds, they're not buying meme coins. They're buying Bitcoin and Ethereum, and they're buying them consistently over time. Let me show you why conservative beats aggressive in the long run. The average altcoin loses 90% of its value from peak to trough in a bear market. Even if you hit a 10x gain, You need to time your exit perfectly, or you'll give it all back. But a conservative portfolio. In the 2022 bear market, while most altcoins lost 80-90, a well-constructed conservative portfolio might have only lost 40-50. And here's the kicker, it's much easier to recover from a 40% loss than a 90% loss. If you're starting to see why boring beats exciting in crypto, give this video a thumbs up. Now that we've covered the philosophy, let's dive into the actual portfolio construction. This is where it gets really interesting, because I'm going to show you exactly how to allocate your $1,000 across 5 different positions for maximum stability and growth potential. The 5 asset allocation breakdown. Here's the moment you've been waiting for, the exact allocation that forms the backbone of our conservative strategy. I'm going to break down each position, tell you exactly why it's included, and show you how much of your $1,000 goes into each one. Position 1. Bitcoin 40%. 400. Starting with the foundation, Bitcoin gets 40% of our portfolio, which is $400. Now, some of you might be thinking, but Bitcoin is so expensive. Here's why that thinking is wrong. Bitcoin is digital gold. It's the most liquid cryptocurrency, has the highest institutional adoption, and historically shows the lowest volatility among major cryptocurrencies. When the market crashes, Bitcoin usually falls less than altcoins. When the market pumps, Bitcoin provides steady, reliable gains. The BlackRock Bitcoin ETF has brought in over $20 billion in just 1 year. That's institutional validation you can't ignore. Plus, Bitcoin's halving cycle creates predictable scarcity events that historically drive price appreciation. Type BTC in the comments if you agree Bitcoin deserves the biggest allocation. Position 2. Ethereum 30%. 300. Next up, Ethereum gets 30% of our portfolio, that's $300. Ethereum isn't just a cryptocurrency, it's the foundation of the entire DeFi ecosystem. Every major decentralized application, every ENF marketplace, every layer to solution, they all run on or connect to Ethereum. But here's the best part for conservative investors. Ethereum's transition to proof of stake means you can stake your ETH and earn approximately 3-4 annual returns. That's passive income on top of potential price appreciation. With Ethereum ETFs now approved and major corporations building on the network, ETH represents the perfect balance of stability and growth potential. Position 3. Stablecoins plus staking 20%. 200. This might be the most important position in our entire portfolio. 20% in stablecoins, specifically USDC or USD, earning yield through staking. That's $200. This serves 3 critical functions. First, it's our cash position for buying dips. Second, it protects us during market downturns. Third, it generates passive income through DeFi protocols like Aave or Compound, or CeFi platforms like Coinbase. You can realistically earn 3-6 annual returns on stablecoins with very low risk. That's 612 per year on this position alone, which might not sound like much, but it's guaranteed income while you wait for opportunities. Drop A if you understand why cash positions are crucial for crypto success. Position 4. Chainlink 5%. 50. Now we're getting into our smaller positions. Chainlink gets 5% of our portfolio, $50. Chainlink is the infrastructure that powers DeFi. They provide the Oracle services that allow smart contracts to interact with real-world data. Here's why this is conservative. Chainlink has partnerships with Google Cloud, Swift, and hundreds of DeFi protocols. They're not going anywhere. As the DeFi ecosystem grows, Chainlink becomes more valuable. It's like owning the roads that all the cars drive on. Position 5. Arbitrum 5%. 50. Finally, our last position is Arbitrum 5% of the portfolio, another $50. Arbitrum is one of the leading Layer 2 solutions for Ethereum, which means it makes Ethereum faster and cheaper to use. As Ethereum grows, Layer 2 solutions become more important. Arbitrum has the highest total value locked among layer 2 seconds, and their ecosystem is rapidly expanding. This is our bet on the future of Ethereum scaling. Comment portfolio if you want me to create more detailed videos about each of these individual assets. Staking strategies and passive income. Now, here's where our conservative portfolio gets really interesting. We're not just holding these assets, we're making them work for us. Let me show you how to generate passive income from almost every position in this portfolio. Ethereum staking. Starting with Ethereum, you have several staking options. The safest approach for beginners is using a platform like Coinbase or Kraken, where you can stake your ETH and earn around 3-4 annually. That's $9.12 per year on your $300 ETH position. For more advanced users, you can use Lido or Rocket Pool for decentralized staking. These platforms give you liquid staking tokens that you can use in DeFi while still earning staking rewards. Stablecoin yield strategies. For your $200 stablecoin position, you have multiple options. Conservative centralized options include Coinbase Earn or Kraken staking, offering 3-5 annually. For slightly higher yields, you can use DeFi protocols like Aave or Compound. These are battle-tested protocols with billions in total value locked. You can earn 4-6 on USDC with very low risk. The key is to start conservative and gradually explore higher yield options as you become more comfortable with DeFi. Bitcoin considerations. Bitcoin doesn't have native staking, but you have options. Some centralized platforms offer Bitcoin lending services, though these carry additional risks. Generally, I recommend keeping your Bitcoin in cold storage and focusing on staking rewards from your other positions. Risk management. Here's something crucial about staking. Never chase the highest yields. If someone is offering 20% APY on stablecoins, that's a red flag. Stick to established protocols and platforms. Your goal is steady, sustainable income, not maximum returns. Also, understand the risks. Staking usually involves lockup periods, and smart contract risks exist in DeFi. Start small and scale up as you gain experience. Give this video a like if you're excited about earning passive income from your crypto portfolio. Portfolio maintenance and rebalancing. Building the portfolio is just the beginning. The real skill is in maintaining it. Let me show you the simple system that keeps your portfolio optimized and your risk managed. Rebalancing is crucial but simple. Every 1-3 months, check if your allocations have drifted more than 5% from your target percentages. If Bitcoin has run up and now represents 50% of your portfolio instead of 40%, you sell some Bitcoin and buy more of your underweight positions. This forces you to sell high and buy low, the opposite of what most people do emotionally. It's a systematic approach that removes emotion from your investment decisions. Use a simple spreadsheet or portfolio tracking app to monitor your allocations. Set calendar reminders to check quarterly. You don't need to check your portfolio daily, but you should stay informed about major market trends. Pay attention to Bitcoin dominance. When it's high, altcoins usually underperform. When it's low, altcoin seasons typically begin. Also monitor the yield rates on your staking positions. If rates change significantly, you might need to adjust your staking strategy. Never keep everything on exchanges. Use a combination of hot wallets for DeFi activities and cold wallets for long-term storage. Hardware wallets like Ledger or Trezor are essential for serious investors. Enable two-factor authentication on all accounts. Use strong unique passwords, and be extremely cautious about phishing attempts. The crypto space is full of scammers targeting inexperienced investors. Comment security if you want me to make a detailed video about crypto security best practices. Closing, let's recap what we've built today. $1,000 conservative crypto portfolio with 40% Bitcoin, 30% Ethereum, 20% stablecoins, 5% Chainlink, and 5% Arbitrum. This allocation prioritizes capital preservation while still capturing upside potential in the crypto market. The key principles are diversification, time horizon thinking, and passive income generation. This isn't about getting rich quick, it's about building sustainable wealth in the crypto space. If you found this breakdown valuable, here's what I need you to do. First, smash that like button and subscribe to the channel if you haven't already. I create content like this every Tuesday and Friday. Second, leave a comment telling me, are you going to implement this strategy? What questions do you have about the allocation? I read every comment and often create follow-up videos based on your questions. Third, if you want to see more detailed analysis of any individual asset in this portfolio, let me know in the comments. I can create dedicated videos for Bitcoin strategy, Ethereum staking, or DeFi yield farming. Remember, this is educational content only. Never invest more than you can afford to lose, and always do your own research. Until next time, stay safe, stay smart, and keep building that wealth steadily and conservatively. And hey, if you're serious about crypto investing, check out my playlist on risk management strategies. It's linked in the description. See you in the next video.